Welcome to the Plan Solutions Incorporated podcast. I'm Jason LaChance, and we'll be speaking with President of Plan Solutions, Chase Armour. If this is your first time, please hit that subscribe button on whatever platform you're on, Apple Podcasts, Spotify, where you can leave us a rating and a review, or you can go now to our YouTube channel and follow along to the personal financial review by watching it on video. All you have to do is look for youtube.com/@plansolutions, and you'll find us. If you haven't subscribed to the Personal Financial Review, the written content we discuss, send Katie an email there at Plan Solutions. That's KATIE at plansolutions.com. Mr. Armour, we're going to dig into some great topics: U.S. job market, long-term interest rates rise, maturing CDs, and a look at the bulletin board. But how are you doing? We're post-tax season, so I'm hoping you've come up for air now.
That's right. Yeah, it feels like a big weight has been lifted. You get rid of that deadline, less stress. It's kind of a little bit of slower pace, which has been nice.
Yeah, absolutely. All right, well, let's dive right in here. The U.S. job market has been, in discussions, and we touch on it quite frequently. But there seems to be some mixed reports going right now that maybe state that it's worse than it is. I haven't seen any that are stating that it's way better than it is. But what are we accurately seeing, and how do we really gauge the job market?
Yeah. Part of the reason we do the newsletter, we do this podcast, right, is we want to bring some good educational material, remind people about different strategies and things they can use. But one of the other big pieces is just kind of looking at the mainstream financial media, and you get these reports or these stories that kind of make the rounds, and they're not always telling the whole picture, right? And that's one of the reasons why we always prefer to just go straight to the data. You might read an article about this is happening, that is happening. Okay, let's go straight to the data and see what's really going on. And I think this is a great example where I've had a number of questions from clients and other people looking at some of these reports and saying, why is the job market so bad? And I'm thinking, wait, the job market doesn't seem that bad if you look at the data. But there's a lot of reports about, big companies with layoff announcements, right? You hear, this company is cutting 3,000 jobs. This company maybe is cutting 5,000 jobs. And we've seen a pretty steady stream of those, I'd say, over the last 6 months or so. And then there's also been quite a few, anecdotal things in the media or on social media, where it's talking about young people having a difficult time securing usually, white collar jobs right out of school, and kind of saying, this job market is not very good because, look, I've had this many interviews and I haven't gotten an offer or something like that. And so I'm not, necessarily questioning that those things aren't happening. I mean, there are companies that are announcing layoffs, and I'm sure, some people in certain circumstances maybe are having a harder time finding jobs than others. But I don't think it's really showing the full picture, and it doesn't help people really understand kind of the dynamic nature of the U.S. labor market.
Sure, absolutely. Well, we just had a report as of the release of this podcast, maybe it was, about a week ago, Google's laying off people looking to expand into foreign markets. There's certain industries, of course, where this is happening, but it doesn't necessarily paint the overall picture across the United States.
Exactly. There's always certain pockets, where things are changing. It's partly why the unemployment rate in the U.S. is never zero. Right. There's at any given point, there's going to be millions of people that are out of work and looking for work. And so, economists estimate that the full employment rate really is somewhere between 3 and 5% of the workforce. And that's just due to these frictional forces that are causing some workers to be unemployed, even in cases where the job market's really strong. Right. You can have people leaving a job because maybe it's a poor fit for their education, job skills, or future aspirations. Right. It's just not a good fit. So they leave that job. They're technically unemployed and looking for replacement work. Even in good markets, right, there's going to be companies that need to reduce their headcount because maybe the industry that they're in, or maybe they're just not competitive. And they're feeling these market pressures, or the goods or services that they produce are just no longer in demand, right? You're always going to have kind of those frictional things as some companies are going by the wayside as new things are coming in, or what economists call creative destruction. And then as you pointed out, some industries, right? Some industries maybe will overhire at times and then need to right size by letting some people go. Whereas, you may have other areas or other industries that are thriving and looking to hire, but there's kind of a disconnect between the job skills, right? And so that can create a delay where maybe people need to be retrained, or it just takes time for the market to work itself out. And then, of course, you have, young people, exiting college or high school. They might have a difficult time finding unemployment, really, especially if they didn't coordinate their studies with the demands of employers on the market, right?
Right.
That's the key, is that they have those job skills that are quickly able to be translated into job offers, because, they're going to be able to hit the ground running, or they understood the industry that they were targeting. So they're able to make themselves appear to be a good candidate.
Yeah, well, and I mean, I like to use you and I as an example. We both were interns in the industries we wanted to work in while we were in college, so gained a lot of that. And I'm seeing, the lack of maybe recognition, or younger folks being educated that is oftentimes necessary, to present that, so you do have some sort of a built resume. And then another situation that I'm seeing again, and did hit me at one time, is certain industries leaving an area, but folks being stuck to a geographical location. So maybe it takes a little while for those skill sets to land somewhere.
Yeah, that is one of the big challenges, is the U.S. labor market has proven to be less mobile. And that could be, a variety of factors, but part of it is, people just hesitant to move, right? To relocate for work, more so than they have been in the past, and that can limit opportunities. So yeah, there's a lot of different, variables or factors that can lead to this frictional unemployment. But in looking at the big picture, the nationwide unemployment rate is still around 4%, a little below 4%. So it's historically very low. It's ticked up slightly recently, but from what has really been a very low level that really we hadn't seen since before the pandemic, and then before that you have to go all the way back to 1999, 2000, when the unemployment rate was as low as it is now. So granted, the unemployment rate is typically a backward-looking indicator. A lot of people don't equate that. It's the most commonly cited labor market indicator, but it is backward looking. But it's showing that we've been in a really strong job market. The best forward looking indicator is generally the initial claims for unemployment insurance. So those are people that are now filing, to start claiming unemployment insurance, a sign of, weakening job market. But currently, initial claims are very low at 211,000 per week. I mean, that's very strong, indicates a really strong job market.
Yeah. Well, and what has that trend been like? What was our recent peaks as far as the initial claims for unemployment insurance?
Well, during COVID, it went through the roof. I mean,
Right.
hit numbers that we haven't seen in a long, long time. I mean, we're up there around, million plus per week, claiming unemployment. So, yeah, bigger than anything I've seen at any other point in my career, including the financial crisis, just because it happened so quickly. But historically, if you're down around 250,000, that's an indication of a really strong job market.
Yeah.
So, the question is, okay, so if initial claims for unemployment and the unemployment rate are looking so good, then, how do we equate that with what we're seeing in the media in terms of high, layoffs and people having a difficult time finding a job? And I think there's several explanations there. I mean, one is it may be that the job market's strong enough that when people are laid off, they're finding new jobs quickly enough that they're not even bothering to file for unemployment, right? And so that would keep the initial claims low. Not to say there aren't jobs that are going away, but it's just other positions are being filled very quickly. Or it could be that when a company announces layoffs, it doesn't necessarily mean it happens immediately, and maybe they're spreading them out over time. So in the aggregate, they're just not large enough to have a meaningful impact on the initial claims for unemployment insurance. But either way, it's a sign that the job market is still really strong. That we're not seeing any type of real significant deterioration in the health of the U.S. labor market.
Yeah, all a good sign. Anything else you want to add before we jump to long-term interest rates?
Well, again, I would just stress, when it comes to these types of questions or things, it always pays to go directly to the data, right, and see what's really going on. Because as we know, anyone can make an argument about a lot of things by picking and choosing what data they want to highlight, and maybe not necessarily looking at the big picture. And it can tell a very different story, and potentially cause people to be more concerned, more pessimistic during a period where maybe they should be more optimistic.
All right. Well, let's jump into long-term interest rates rise. We've been touching on interest rates because it's obviously been a very hot button topic over the last 4 or 5 years or so. But we're seeing long-term interest rates rise. What's going on? Why are the Feds making this decision? Is this also a sign of strengthening the economy?
Yeah, so the yield curve has been a little sneaky, you can argue. We've been so focused on short-term rates, right? Waiting to see, what would happen with inflation, what the Fed would do with interest rates, looking at economic data and poring over the Fed dot plot where each of the Fed governors gives their prediction for the future path of very short-term interest rates. And that's been a big focus of the financial markets. But what's been missed to some extent in that is while inflation has stayed stubbornly above 3%, the Fed has kept short-term interest rates, pretty much set at that 5 to 5.25% range. And so we're seeing that with a lot of, short-term, bond CDs, that type of thing offering around that rate. But while those short-term rates have remained fairly stable, we've seen a pretty big move in longer-term interest rates. The 10-year Treasury started this year below 4%, declined pretty good late in 2023. And so it moved down quite a bit. But then this year has moved up and is now sitting at 4.6%, which is the highest rate we've seen since October of 2023. And it's not far from the previous high, which was just shy of 5%. Back in the kind of late summer, early fall last year.
Well, this begs a big question for me. How does this affect borrowers and lenders?
Yeah, well, obviously borrowers, it's pushed mortgage rates back up above 7%. It's definitely made longer-term debt more expensive. But for lenders, this, could potentially be a good opportunity, right? There was an opportunity to lock in these higher interest rates for a longer time period, about a year or about 4 to 6 months ago, and then that was kind of lost with longer term rates earlier this year at below 4%, and you're looking at it, do I want to lock in a rate below 4% when the short term rate's 5%? That seems like you're giving up a lot in the short term to potentially benefit in the long term. But now with longer term interest rates up around 4.6%, short term interest rates at 5%, you're still giving up a little bit in the short term, but potentially could get a big long term benefit by locking in that higher interest rate. And because should we see short term interest rates start to fall, you might not average 5% over the next 10 years, whereas 4.6% average rate of return over the next 10 years might end up being pretty attractive compared to other options over that time period.
I want to tie this into the previous topic that we were talking about with as far as the U.S. job market. In a situation like this, does this also hinder maybe businesses potentially growing, expanding due to the higher long-term interest rates, maybe the restructuring of debt, et cetera?
It could. Yeah. If they have to roll over debt and face higher interest rate costs on that debt, right, that's going to take cash flow away that could be used for other things such as investment. It's also going to increase what we call the weighted average cost of capital, and that's the calculation that you use when you run out a new investment or a new endeavor, you say, what are the cash flows that we expect? What are these returns over time? And then you discount them using the weighted average cost of capital to say, what is the return on that investment? And the higher the weighted average cost of capital, the fewer of those types of investments or, new activities that are going to make the cut because they just won't produce, potentially high enough rate of return to offset the potential risk.
Thank you. I was curious about that. Is there anything else that we want to lock in here? I mean, what is the investor maybe wanting to think when this occurs?
Yeah, I think it's just a good time for people to really take stock on what's happened and look at the relationship of short-term yields versus long-term yields. Obviously it's going to be based on their individual situation, what the funds are to be used for, right? Their expectations on tax rates and inflation. I mean, there's a lot of factors that go in. But I think this is worth pointing out that, this is a great opportunity where potentially you have a second bite at the apple, as they say, to be able to lock in these higher long-term rates during this cycle. Whereas expectations are still that short-term rates will fall. We may see long-term rates come down. So, we may not have this opportunity for that long, depending on what inflation does and, what other dynamics we see within the bond market.
Absolutely. All right. Well, a perfect segue here. Maturing CDs, certificates of deposit. Investors who recently invested in CDs within the past year or two have benefited from those higher interest rates, but we need to talk about the maturing of the CDs.
Exactly. Yeah. A lot of people think of CDs as just kind of a set it and forget it type thing, because they're kind of, maybe a little boring, right? Money just sits there, it earns the interest, and CDs mature, and then generally they will roll over at a lot of institutions. Some they'll be paid out into cash, into a savings or a money market, and some they roll over. And both of those can have significant implications in the long-term rate of return, and is something that needs to be monitored, right? It needs to be monitored and tracked to make sure that you're getting attractive rates of return. Partly, there's the risk of interest rates declining and those CDs mature, and then you get rolled over into something that's not paying as much. It could be that you signed up for a CD on a promotional rate, right? So the CD looked attractive because they were offering kind of this higher promotional rate to attract deposits. Then the CD matures and you go into, the standard rate that maybe isn't as competitive, with other institutions. Or it could be that the CD matures and gets paid out to a money market or a savings account that's paying a much lower rate than what you would otherwise would be earning. And the longer it's sitting there, rather than being moved into, some other type of money market or CD that's offering a higher rate, that can have a big impact on the long-term average yield or the long-term rate of return that people earn.
What happens, let's say you've invested in a CD, it matures, they roll it over into just your savings account. So tell me if I'm understanding this correctly. Is that a situation then you're being hit with tax implications as well? Because obviously you've earned some return, I'm guessing, on said investment.
Yeah, you will be taxed on the interest that's being kicked out by the CDs. So that's also something that needs to be taken into account. And, potentially if you don't have other sources of quick access to, liquid accounts, you may need some of that money, right? To be able to cover the taxes. And let's say you buy into a 2-year CD and it's kicking out interest, and you're going to have to report that interest and pay taxes on it. Some we talked about in a past podcast, there was a big wake up call this tax season was just how much people's interest earnings had gone up when we went from a world where you're earning 0.5% to potentially 5%. I mean, that's a tenfold increase in the interest that's being earned. Well, if that CD, let's say, matures and then automatically rolls over because you didn't do anything, you could have that money locked up for another 2 years and potentially have to, pay a penalty to break the CD to get access to the money. So, often that penalty is a certain time period of interest, whether it's 3 months or 6 months or something like that. So again, that could have a big impact on your overall rate of return as well. If you're not really paying attention to those CD maturity rates and kind of monitoring and managing your cash flow needs to make sure you have an overall cash management strategy that'll meet your needs, including the potential for to cover those heightened or elevated tax bills.
What's the best recommended way for someone to watch after it? As simple as writing on a calendar, hey, this is when my CD is maturing. I need to connect with my financial planner on the best strategy moving forward.
Yeah, yeah. I mean, some people still use paper calendars, or obviously, we all carry around these smartphones where you can set reminders, right? Things like that. I mean, typically, if you have a financial advisor, you hope that they're monitoring all of that. And if the CD matures, there's either already a strategy in place that they can go ahead and implement, or they'll reach out and say, okay, what should we do with these funds? What's the, have things changed? So, do we need to change the strategy? And often, banks, when CDs mature, will send out a notice saying, hey, your CD's matured. You have this time period to decide what to do. Otherwise, it'll be automatically rolled over into a CD of a similar maturity as the one that recently matured. So paying attention to those things, right? Sometimes it kind of looks like junk mail, but in fact, you should at least open it and take a look and make sure that it's not an important notice.
Yes, sir. Anything you want to add before we jump on over to the bulletin board?
Well, just early in my career, cash management was important, and it was something that we spent a lot of time on because interest rates were high, and you could really move the needle by making sure that you were maximizing returns on even low risk investments. And then for a long time there, it really wasn't that valuable. I mean, interest rates were so low, there wasn't a lot of value that we could add. So it became pretty simple. You typically just opted for liquidity and, try and get a little bit of earnings, but there wasn't a lot on offer. Now we're back to a period where, interest rates are high compared to where they've been the last 10, 15 years. And so I think for a lot of people, it's, needing to pay more attention now and adjust back to that mindset of, 15, 20 years ago, when we really had to put in more effort, but we're able to capture much higher rates of return.
Yeah, absolutely. All right, let's jump on over to the bulletin board. We got one item pinned up there, Mr. Ermer.
That's right. Yeah, we're here doing a podcast, and I'm recommending another podcast. NPR has a podcast called Planet Money, which I would recommend in general. I think a lot of the short little episodes they do, usually 20 to 30 minutes on different topics, can be a great way to learn about different things going on in the financial world. But they did one recently that I wasn't really aware of, and I think they did a great job of covering it. The episode was called "TikTok and Other Apps Like It Are Filled with Financial Advice. Is Any of It Worth Listening to?" It was published on April 12th, so right before tax deadline. Good timing. But basically what they pointed out is that more and more people are getting financial advice, including tax advice, from social media apps like TikTok. But they don't realize that in many cases, the claims that are made are incorrect, they're exaggerated, or they're designed to mislead people, right? I mean, the typical, if it sounds too good to be true, it probably is. And some of the examples that they were playing, definitely would fall into that category. But as with most things designed to deceive people, there's just a small grain of truth in there, right? So it sounds just plausible enough because they can cite an IRS code section or something like that, but then, make these big exaggerated claims of something that would never pass muster with the IRS. So I thought it made sense to, one, we want to warn people about taking financial advice from TikTok or other apps. Again, anytime you're getting financial information online, it's important to assess the trustworthiness of the source, and especially the experience and credentials that qualify someone to give advice, including financial advice, and especially tax advice. Because in a lot of these cases, if you followed the recommendations on these apps, I mean, basically what you'd be doing would be considered tax evasion. And this person who's trying to build a social media presence or trying to become a financial guru or influencer, they don't work for you, right? And they don't have your best interests in mind, and they don't need to. That's not part of the deal. It's a buyer beware, or you are responsible for that tax return that you're signing and making sure that it's accurate and that it conforms to the law.
Yeah, well, my often advice for people, I've had people reach out in the other career industry that I work in and go, is this good advice? Is this true? And I said, what did it start with? I'm the cure to all your problems. Keep scrolling at that
Yeah.
point. Keep scrolling. That is not the promise you want.
Yeah, yeah. In our industry, it's the financial secret that the wealthy don't want you to know about.
Right.
Right. That's always the thing. It's a secret, and somehow they know all these secrets, and it's been hidden from everyone else, and people believe that, right? They think that the wealthy have these shortcuts or whatever it may be to get to where they're at, and generally what you're being told to do is either a really bad idea or something that's just not even legal.
Right. Anything else you want to add, Mr. Armour, before we wrap up this edition of the Plan Solutions Incorporated podcast?
Well, I think on the same topic, right? I mean, that's part of the benefit of having a financial advisor. And I think people should not hesitate to, reach out to their financial advisor if they see something that kind of piques their interest, but maybe they're not sure if it's accurate or not. It may be, right? If you reach out to a knowledgeable financial advisor, they could tell you, yeah, that is a strategy that you could consider, and maybe we should discuss it. But more importantly, in those cases where it's something that's just a really bad idea that's going to get you in trouble, they can probably point you to some more accurate or reliable sources or information on it so that, you can make a more informed decision and maybe realize that, that's not the best idea.
Absolutely, because getting an extra big bill from the IRS or getting an audit is not the path you want to go.
That's right. And you know what? You want to focus your efforts on the legal tax deductions and strategies that you can use. One of my very first tax clients was in a situation where he was being audited. In fact, his tax preparer, the IRS, had come in and audited their entire practice for taking just outright fraudulent and made up deductions. And sitting down with this individual, we kind of talked through it. And what I realized is his tax preparer had missed a whole bunch of legal deductions, right? Had just gotten lazy and making things up and really, pushing the envelope beyond any reasonable point, but wasn't doing the actual job of spending the time saying, hey, what other things can we deduct? What other things have changed that maybe we could take advantage of? And in that case, I was able to at least reduce the tax bill, the substantial tax bill that this individual was facing because of the activities of their tax preparer. And I walked away thinking if they had just spent the time doing the actual job, legally and correctly, they would have been able to add value and wouldn't have put themselves and all their clients at risk.
Yeah. Well, and that's why you guys are great at what you do there at Plan Solutions. Anything else you want to add, Mr. Armour?
Just hope everybody has a happy spring. We're finally getting some good weather here, hoping to get in some golf, and looking forward to a little less strenuous schedule.
Yeah, hopefully this late season rain has pushed off for us. And I recently got snowed out, was going to Yosemite to find out in the morning, unless you have chains and four-wheel drive, don't come here. So hopefully these kind of things can start to happen. We can get out and enjoy the weather and all the wonderful scenery. Well, we thank you all for listening to the Plan Solutions Incorporated podcast. Please hit that subscribe button if it's your first time. Leave us a rating and review, Apple Podcasts, Spotify. And if you want to enjoy now on YouTube, where you can follow along the personal financial review on video while Chase and I discuss here, please go to the YouTube, and it's at Plan Solutions. Subscribe there. Leave some comments on the video. Maybe if you have questions or future topics that you would like Mr. Armour and I to discuss, you could leave them there as well. And to subscribe to the Personal Financial Review, send Katie an email, KATIE @plansolutions.com, and get subscribed today.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.